Great. Okay, I think most folks will kind of dial in as we go, but let's just get started. So hey everyone, thank you for joining, our State of the Office panel. Most folks in the audience, work in real estate or are part of LGREG, which is an LGBTQ real estate networking group. We have chapters in a variety of cities like San Francisco, Los Angeles, New York, and Boston. So anyhow, if you'd like to learn more, visit our website at westlgreg.com. If you can't, memorize that site, feel free to email me as well or one of us, and we can ping it to you. So that's just a quick plug for our group. We're also hosting a State of the Apartment panel on March 18th. That's hosted by Jake LaJoy of Frost Chaddock, which is a development firm based in Los Angeles, and we'll send out a calendar invite for that as well. So now let's begin. So most of us, are out of office at the moment, except for a few folks in this panel who are back in the office. But I think it's a timely topic, whether you're an employer or an employee, a landlord or a tenant. And to just kind of quick housekeeping items, the format of this panel is pretty interactive. The first 30 minutes or so will be, to cover some office statistics, hear from a few office landlords, and then dive deeper into what tenants are thinking about regarding their office space. And I actually launched a poll question, kind of 2 truths and a lie format, and it's anonymous, so feel free to make mistakes, but one of those facts is not true. And we'll go over that when we kick off the Q&A panel in a little bit. And then we have lots of folks participating through the magic of Zoom. So if you can send me your questions or do a raise hand function on Zoom, I can try and consolidate sort of the most asked questions. And then just to kick it off, we'll do kind of 1-minute intros, and then we'll jump right into some of the questions. And then just for everyone's record, this Zoom is recorded just in case anyone who couldn't attend it and wants to hear about it. We're going to record it. So now I'll kick it off with introductions. My name is Ryo Shida. I work for Rainbow Capital Partners. We drive social change by gaining LGBTQ representation in commercial real estate fundraisers. We typically pull capital, mostly LGBTQ capital. About 80% of our investors are LGBTQ. And then we fund real estate projects and funds that have, LGBT co-founders and/or senior leaders. Before Rainbow Capital, I worked for a few private equity firms like Prudential Real Estate Investors and Lindeman Associates. I've also worked on the operator side as well, working for a few developers, and most recently worked for Lyric, which was a short-term rental business backed by Airbnb. And then for the panelists, Robert, why don't you kick it off first with quick intros?
Sure, thanks, Rio. Yes, my name is Robert Sammons. I lead the research team in Northern California and also Portland and Seattle. It's about 13 researchers within that region, and report up through research and marketing at Cushman and Wakefield for the Americas.
Awesome. And then next we'll have Kim.
Hi everyone, Kim Hourihan. I am the CIO of the direct real estate business for CBRE Global Investors. I'm based in New York, and I'm also the portfolio manager for our open-end core fund here in the US.
Awesome. And then Michael, I think we'll have you go next.
Sure. Hi, everyone. Michael Johnston. I work for a company called Menlo Equities, which is a real estate private equity firm based here locally in Menlo Park. We focus on office, R&D, and data center and lab investments in about a dozen innovation hub markets across the country. We have a variety of different investment platforms ranging from open-end core plus funds to closed-end value-add funds to a development business and a separate data center vertical as well.
And then last but not least, Craig.
Yes, hi, I'm Craig Zodikoff, based here in San Francisco. I'm a managing principal in Cressa's Bay Area operation. My personal practice has been focused heavily on portfolio clients. So the clients themselves might be based in the Bay Area, but the work could be anywhere domestic or global. Cressa as an organization has about close to 60 offices domestically and another 20 offices globally.
Awesome. Hey, so Robert, just to kind of set the stage for everyone, since you're in research and kind of have all the stats and numbers from Cushman, can you kick us off with a quick presentation on kind of what's going on in the office world, and can highlight on some of the key gateway markets?
Sure.
Your presentation here. Let me know if you see it on screen.
Yeah, if you want to go to the next slide for me, Rio, and I'll try to be as quick as possible. Here we go. Let's start with GMP very briefly. I am a research nerd, and I get into numbers and stats and all of that good stuff. But I'll be as quick as I possibly can to get through all this information. So obviously, GMP really across the US was down significantly in 2020. Some hard hit markets, New York, Las Vegas, Miami, San Francisco, they were dinged very hard last year. But over the next 5 years, we feel, certainly in the forecast from Moody's shows that these markets are going to recover rather strongly. Not surprisingly, Sunbelt and some other West region markets were not as affected in 2020, and we'll also see strong growth over the next 5 years. You can go to the next one. And really, on the next slide on the office market, office using employment, this is probably one of the most important slides in the entire deck. Pretty much expected to improve across the board for the major markets in 2021, though again, some of those markets didn't miss much of a beat in 2020, like in Austin or DFW, Raleigh, even Houston. Some of the markets are expected to remain below year-end 2019 levels by the end of this year, including LA and New York and Las Vegas. And in the Bay Area, though, the forecast for Silicon Valley and for San Francisco in regards to office jobs are that we will both basically be back to our near record levels by the end of this year as far as office job count goes. Of course, that doesn't mean necessarily butts in office seats, of course. It just means people based in Silicon Valley, people based in San Francisco, those companies will bring back hiring, bring back office employees, though they may be working obviously away from the office itself. Okay, and the next slide. We kind of pivot toward occupiers of office space and look at sublease space as well. Let's talk about occupiers for a second. Not much happened in 2020. Almost all leasing came to a standstill. There were some short-term renewals. That was certainly the flavor of the year. Many of the tenants either downsized or didn't adjust their square footage at all. We're beginning to see more tenants re-enter the markets, and that's a really great sign. We're seeing that in places even like Manhattan and in San Francisco. In fact, like in San Francisco proper, we had about 6.5 million square feet of tenants in the market going into the pandemic. It fell to about 3 million square feet right after the pandemic began. It's ticked higher now. It's about 4.1 million square feet in January. So improving, moving in the right direction. If you're a landlord or represent landlords, that's certainly a good sign, but vacancy certainly is still very significant and asking rents are down. If we speak to sublease trends, that's certainly been front and center in any discussion on the office market. San Francisco, Manhattan, both hit hardest over the past year. We just released our latest sublease report last week. As of the end of 2020, we looked at our 83 markets across North America. Sublease vacancy in 2020 was up 80% from year-end 2019. Happy to send that report out to anyone that wants to see it. Other markets recording a large increase may surprise you to some extent. Chicago, Boston, even Dallas and Austin saw a huge run-up of sublease space. Denver and Toronto as well. You can move on to the next. So go to the, yeah, here we go. US vacancy rate. This is a little bit of a forecast look, a little bit behind the scenes of the C&W scenarios we see moving forward. We have a baseline vacancy rate and also an upside and a downside. Pre-COVID, the vacancy rate across the US was at 13.2%. We see that continuing to rise, and by the end of 2024, closing it out at about 15%. We do have that upside downside scenario, and that range is really between 13.8% and 17.8% by year end 2024. So still significantly higher than where we began. But after we hit about mid-year 2022 or so, improving slowly but surely through 2024. If we go to the next slide and speak to the asking rents at the national level, and we stick with that baseline forecast, we're forecasting a peak to trough declines somewhere around 14% for the CBD markets, only about -7% for the non-CBD markets. Those CBD markets having a little bit more difficult time coming back in the recovery period. But we see the recovery really beginning at the end of this year end 2021, as far as rents go. And that's asking rents, but also really effective rents too. On the next slide, we can go into the Bay Area and get to the nitty-gritty of it and talk about San Francisco a little bit. And I kind of focused on the Class A side of things here. And these are asking rents, obviously, in the blue bars, and the asking rents in the yellow or orange line, and blue bars are the vacancy rate. And you can see here, our vacancy rate tripled over the past year. It went from 5.2% going into this to 15.1% at the end of 2020. I will say, though, that in San Francisco, we had the lowest vacancy rate going into the pandemic. We had the highest average asking rents going into the pandemic, even higher than Manhattan. We were pushing tenants out of the city, even during that segment of the market, because essentially we had no space, we had no big blocks of space. Smaller tenants couldn't really afford to be here for the most part. They were looking elsewhere, whether that be in the East Bay or in other markets across the country. So that really became a big issue. We had very little construction delivering over that period of time. And of course, there were other issues that we all probably know about that know San Francisco at all. The cost of living, more about the cost of doing business, especially taxes, and quality of life issues, quite frankly. If we go on to the next slide, let's talk about sublease space a little bit. A huge run up of sublease space in the second and the third quarters in particular. You see that little box at the top there that shows the vacancy rate climbing 96% among the sublease space, and 60% in the third quarter, but improving only up about 17% in the fourth quarter. We see that being the continuing trend through the early part of 2021 as well. Certainly sublease space higher than at any time since the dot-com recession in San Francisco. But I will say there were a lot of blocks that hit the market prior to the pandemic. Uber was relocating its headquarters down to Mission Bay. They put about 900,000 square feet on the sublease market prior to the pandemic. Macy's.com originally was headed to Atlanta, now backfilling space in Manhattan. They have left the market. Credit Karma relocating its HQ to Oakland. Dropbox probably took more space than they needed to begin with. Now they're rethinking their space needs. They put most of their headquarters on the market. And then post-pandemic, companies like Yelp and Twitter and Levi's and Stripe, and more from Uber, quite frankly, plus a number of smaller tech and professional services firms too. But we did do a deep dive into the sublease spaces on the market at the end of last year. We looked at 182 subleases, totaling about 5.4 million square feet. And we talked to tenants, we talked to landlords, and we feel pretty strongly that about 20% of that space could be reoccupied by the tenants that lease it. With the vaccine rolling out, tenants are feeling much more comfortable that they may be able to reoccupy some of that space toward the end of this year. They may not need to sublease it after all. And honestly, there's not a lot of tenants out there looking to lease some of these blocks of space, even though it may be built out and highly functional. So we're going to have to kind of wait and see how that plays out, but we think it may, by the second quarter especially, start to improve on the sublease side. And on the next slide, let's kind of take a dive into Silicon Valley a little bit. Silicon Valley turned out to be not as hard hit as San Francisco proper. It's not as affected by mass transit, for instance. It's also controlled by several very large tech tenants. The vacancy rate has increased, but nowhere near the record levels seen during the DCR or the GFC. Asking rents have probably plateaued, though. There is a good bit of space coming to the market as far as new construction goes. Certainly, we've all seen in the press a couple of the major Silicon Valley occupiers making news about relocating their headquarters to Texas. That's not going to be helpful, but at the same time, they haven't really been the growth engines of late for Silicon Valley. and they are expected even so to retain a significant employee base in that market. So if we go to the next one, it's a little bit more on R&D space. We really don't need to get into that as much. It's about the same story as office. So you can kind of move ahead to life science on the next slide, I believe, which has really been the star of the show, really across the country, but specifically in the Bay Area too. A hot market, not as much square footage as you may think initially, about 40 million square feet within the Bay Area, considered life science space, but performing really well, really didn't miss a beat during the downturn at all. Looking to expand further, probably into the East Bay, particularly in the Emeryville area, but also into the city itself. And they're considering certain buildings in Central Soma, for instance, maybe pivoting those from office use to life science use going forward. And quickly on the next slide, I think we talk about Manhattan, very similar issues to San Francisco, a huge uptick in vacancy rate, most of it being sublease space. The only difference here really between San Francisco and Manhattan, besides the square footage, the inventory levels, 84 million square feet in San Francisco and 450 million square feet in Manhattan overall, really is the fact that they've had so much new construction in Manhattan right now, whether it be Hudson Yards or in Lower Manhattan. So that's the differentiator there as opposed to San Francisco. We still see the same story playing out there with vacancy rate ticking higher through the end of this year, asking rents continuing to fall, and that will continue to be the case. Although there have been several major deals signed from tech companies in Manhattan over the past few months, so that's some good news in that market. And I think finally, talk about sublease space. We don't really have to get into that. We've kind of hit that on the next slide. You can move forward on into, I think Austin is my last slide. And I think this may take some people by surprise in that the fact Austin at the end of the year last year had essentially the same vacancy rate as Manhattan and San Francisco. They've had a huge jump from 7.7% at the year end 2019 to 16.7% at year end 2020. Asking rents have continued to climb as well. The fact is they've had a lot of new construction hit, and they haven't necessarily signed a lot of new deals. As I hear from my researcher in Austin, they've had a lot of tenants looking, but no one signing on the dotted line yet. I think certainly Austin is the happy place these days across America, where everyone sees silver linings. But we'll have to wait and see how it plays out if tech tenants in particular, really start leasing large blocks of space in that market. And I think they probably will this year and into 2022. But they do have a lot of space delivering in Austin. And that is it. I'm done.
No, Robert, that was a lot of info in a couple of minutes. The bottom line, it sounds like obviously gateway markets like New York and Manhattan are hurting. A lot of it is driven by sublease vacancy and kind of trends that were already happening before the pandemic. And then states like Texas are obviously winning on the draw for new talent and new office space. So kind of with that framework, right? It's kind of a TBD on what the post-pandemic recovery will look like. But let's kick it off to kind of to Kim and Michael who are on the office investment side. And Kim, we'll start it off with you. Can you talk a little bit about CBRE Global Investors, kind of your current office portfolio? And then Michael, we'll hand it over to you as well.
Yeah, I mean, office is interesting these days. I think literally every investor that I talk to asks me about the future of office. And I think it's in a lot of ways because most people go to an office every day and they haven't been in the office and they kind of want to know what's going to happen. Our portfolios are pretty heavily underweight office, but we were underweight office because it was late cycle, and office tends to be highly volatile compared to the other asset classes, and also has the lowest returns, certainly late cycle and after a crisis. And what's interesting, and listening to what Robert was saying, office users are behaving the same way they always do after an economic downturn. They lay people off and they put sublease space on the market. Certainly this one's been pretty severe, but so has the downturn and all the question marks. I think really the most interesting part of some of the things that we can talk about today is what do we think the impacts of work from home are going to be and how that's going to affect the office space. And what do tenants want now? Because it's still all about good talent and keeping your talent. So, what does that office space of 2023 look like, or 2024, when we're on the kind of firmly on the other side of this, which has some really interesting implications. I mean, we already saw de-densification pre-COVID. We already saw some flexibility around working from home, but will we be traveling as much? That's just as interesting a question. You can do Zoom, so maybe once a year you're seeing a client, and the other 2 times you're doing it via Zoom. So there's a lot of interesting pieces out there that are big question marks.
Yeah, and Kim, to that point, sorry, just to follow up, like, are you guys, changing your investment strategy currently, or you're more of a wait and see, and let's wait a couple of years or a year or so to fully change our strategy here?
I think a little bit of both, to be honest. We actually did buy an office building in Soma in San Francisco in July. So, and haven't even looked in San Francisco in years. Why? Because I believe that San Francisco and New York will come back. They're great cities, and there was a reason that people wanted to be there in the first place, and pricing was off significantly, and you could underwrite with at least some degree of reality, whereas before you would hold your nose and jump in. So I do think that we'll be cautious on what we buy, where, and why. But people are going to be in the office. I mean, Zoom is working because it has to work, because we don't have any choice about it. But collaboration and creativity and just connections with people are just so far off that you can't help but think that you're going to be in an office someday. At least I hope. I have been in the office, but there's 1 or 2 people in the office. So it's kind of like, why bother to even go? So we have changed. We are continuing to underweight office, but if you wait for too long, you'll miss it, right? So there's a little bit of 1 foot in, 1 foot out, to be honest.
Yeah, Michael, what about you? Can you explain kind of what Menlo Equities does, and what's your current office exposure? And then are you shifting your strategy at all for office investing?
Sure. So Menlo is a little bit different than CBREI in that we predominantly focus on office, so we don't invest also in retail and multifamily, and so we're not able to kind of make shifts between the different product types. We have a portfolio that's probably about 7 million square feet right now. Probably 6 to 6.5 million square feet of it is office, the balance being some data center, some lab, and some logistics. For us, we focus mostly on large corporate tenancy. So, our average tenant size in the portfolio is probably 100 or 150,000 square feet. So it's, public utilities, Apple, Target's corporate headquarters, some large law firms in Washington, D.C., et cetera. It's not as much of the, heavily multi-tenanted facilities. So I think, for us, 2020, I think for anyone that's in the real estate business was a really rough year. I think everyone had their heads down and it was pretty brutal. But when we got through to 2021 and kind of looked back at what actually happened in our business in 2020, it really actually wasn't as bad as I think we all thought it was as we were going through it. We actually got quite a, rent collections were strong, 98, 99% really after April being sort of the first month when COVID set in. Office occupancy still remains kind of at that 15 to 25%, just depending on what market you're in. But it was a pretty strong year from us from a leasing perspective, not from, leasing up vacancy and bringing new tenants in, but more from working with our large corporate tenants that came to us and said, hey, can you give us some near-term rent relief in exchange for doing long-term extensions? I think 2020, actually, I don't think we'd had such a good year since 2014 or 2015, and just in terms of, gross leases that we had signed within the portfolio.
No, very helpful. And I'm trying to look for Charles Gibson. I think he's on, but Charles, let me know if you're on and I'm not.
Yeah, I'm here. I'm here.
Yeah, Charles, I wanted to call on you because you're a partner at TMG Partners and, wanted your take on kind of office investing going forward and your current office exposure. Can you kind of quickly introduce yourself to everyone, what TMG Partners does and what you're thinking about in terms of office?
Yeah, so I'm Charles Gibson. I'm a partner with TMG Partners. I've been there for over 15 years. We are Bay Area only. We do different product types, a lot of office, and we also do residential. We have done retail in the past, thankfully not so much recently. So frankly, my career there has been mostly focused on office. And I would say I'm quite bullish on office. And I think now there might be some tenant representatives here who could dispel this idea of mine, like Pierce, but that people are going to go back to, they're going back to the office, and you might be working from home 1 or 2 days a week, but generally speaking, people are going to go back long term. And so all the news stories you see about office is dead, I just don't believe any of that. And we as a business don't believe that. I spent 2020 putting PG&E into the old Kaiser headquarters in Oakland. We bought that asset last year. We did a lease with PG&E for their new headquarters. We've soaked up 900,000 feet of what otherwise would have become vacancy in Oakland. That felt pretty good to us. We solved a lot of real estate concerns for PG&E, or we are in the process of doing so. We weathered the bankruptcy that they were faced with last year. And so we are very bullish on Oakland in particular, as well as the Valley. So down in the Valley, we tend to compete heavily with Michael's company. But to say we're bullish on Oakland, we own 2 million feet of office space in Oakland with various partners, and we have another 2 million feet of development potential. So obviously we're very bullish on that market. We think that, and we have started to see that particularly since the beginning of the year, companies wanting to sort of distribute their campuses around the Bay, not have everything focused in one place. One thing that COVID has taught us all is that commuting sucks, and that if you can maybe commute less and commute shorter, that's a good thing. So our thesis is that that's going to end up resulting in big corporate users distributing their campuses a little bit more evenly than had been in the last cycle, where a lot of folks were very concentrated in the city or in specific parts of the Valley, like a Mountain View or a Cupertino, for example. So yeah, I mean, we're very bullish. San Francisco is definitely the laggard. It's sort of a tale of two cities, and what I mean by that really it's a tale of three markets. There's the East Bay, there's the Valley, and then there's the city, and there's different stuff happening in each of those places. The city is definitely the laggard, and a lot of that is sort of self-inflicted wounds from policy, frankly. So that's sort of the short answer of what I feel about office.
Yeah, Charles, that's really interesting. It sounds like, for better or for worse, it sounds like a lot of the Bay Area kind of owner operators are bullish on office. And it might be that office isn't dead, but it might be that you might have a more hub and spoke model. But I was talking to a bunch of venture capital firms, and they say, for New York and San Francisco, it's still in the long term, right? People want to be in these cities, but more importantly, from a talent perspective, in Austin or Denver to hire, he was saying a couple hundred engineers is very doable in Austin and Denver, but to hire a couple thousand engineers like Google and Amazon, it's really quite hard to do in those cities. And sorry, but we'll get the tenant's perspective from Craig in a minute, which I think will be super interesting. But Will, I see you on. Rubicon, you work for Rubicon, and they own a bunch of office in San Francisco. So just curious to hear your thoughts.
Sure. Yeah. So I've been with Rubicon for 5 years. I'm a director overseeing acquisitions and asset management. We've got about 1 million square feet across the Bay Area, and then we're also expanding into Seattle. The assets I oversee are primarily in San Francisco, and I can definitely echo what others have said about San Francisco really being the most challenging market of all the ones that we're in right now. Consistent with what Michael said, our leased assets performed just fine over 2020, and had some similar experiences with being able to, blend and extend some tenants who are looking for some upfront rent relief. But the assets that had vacancy, those are certainly the most challenged ones. There's been, very little activity in San Francisco, especially in the smaller tenant size range. And, we're just now, the beginning of 2021, starting to, anecdotally hear about increased, tours, and there's a handful of leases that you can point to. But it's, even within San Francisco, it's almost like the tale of two cities with, some very high lease rates being executed in your Class A high rises. But on the flip side, you have the sublease. The sublease market is really driving rents down, and tenants are out looking for deals. And you have subleases that are, Zendesk is asking as low as $20 a square foot in mid-market. Meanwhile, they're touring for more space in the CBD. And, leasing rates on the, average asking rates on a lot of sublease spaces in the 50s, which is, almost 40% off where rates were pre-COVID. So I think we still have a ways to go when it comes to the, dealing with the amount of vacancy that has to be absorbed over the coming years. I think one other interesting thing we've seen in addition to the, the split on the leasing side is on the investment side, there have been a number of sales completed for, single tenant long-term credit deals in San Francisco that are, close to or maybe even above per square foot prices and cap rates that we saw that were happening pre-COVID. 1098 Harrison sold for somewhere in the 5 cap range, over $1,000 a foot. It was leased to Plaid, who was in talks with being bought by Visa. And meanwhile, the number of failed sales that we've seen on the multi-tenant side or non-credit tenancy side is more than the number of successful sales that we saw in the city over the past year. So, it's almost like multi-tenant non-credit buildings with a decent amount of vacancy, your traditional value add are being priced almost the same as a vacant building these days. Meanwhile, fully leased credit tenant buildings are trading close to what they were pre-COVID.
Yeah, so Craig, just shifting gears a little bit, would love to hear, kind of from the tenant's perspective, and can you quickly introduce yourself of kind of which tenants you cover, and what are the tenants saying in the market?
So Cressa, for those of you who don't know, only focuses on the occupier, only focuses on the tenant. And, it's interesting. I think I just want to address a couple things that I've heard. I think that for me and for people I work with, we absolutely believe in the viability of the office going forward. There's no question. And, a lot, Kim, of the things that you said really resonated for me, because the way I think about it is this: there are things that we've learned and been forced to learn about remote work and how to use these technology tools that I think previously the fact that people didn't really know how to use them comfortably was one of the excuses that people had as to how do I manage people if they work remotely. Well, now everybody's an expert at how to use this sort of a platform. And so people who previously said there's no way that our company can go to any degree of flexibility now know that actually if you're forced to, you can. But that said, I think that the humanity of how we work and how we interact every day is something that really matters to people. So recently, I think there was a study that was released, I think it was by Steelcase, actually, the furniture manufacturer, that I thought was really interesting because on the one hand, it was global. So it looked at the impact globally on working from home. And on the other hand, it also looked at people's sort of positions and different aspects of what makes working from home viable or not. And I think what we've seen is that while people enjoyed the flexibility and the fact that their companies that they work for were open to flexibility many months ago, it's become tedious, isolating, and I don't think that people want to live in a world where we are reduced to our tasks. That's all we are. You know, get this stuff done and that's that. I feel that there's a whole level of humanity that really matters to people: connection, professional development, just getting noticed when you're trying to come up through your field, where being at the office, being at work is really important. I also thought that, Robert, one thing that you said was really interesting to me. You said that you speculate that perhaps some of these companies who have put their space on the market may reoccupy those spaces, and that you threw out, I think you said maybe even 20% of them. I agree with you that there's a chance that some of the space will be reoccupied. I'm not sure that it's going to be 20% though. I do think that some people had a knee-jerk reaction to subleasing. However, keep in mind what we're talking about when we're talking about San Francisco. Because vacancy was so low, space was so expensive, and companies had gone to such great extents, especially on the CapEx side, to build out space and relocate and plan on their own growth. I think a lot of companies just had a lot more space than they needed because they were land banking, basically. They were trying to protect their growth going forward. And now people are counting on the fact that there will be vacancy. And so for that reason, I don't think that the reoccupancy of space is going to materially change what's on the market. And what I disagree with in terms of the research that you shared, so I'd love to hear a little bit more about where this comes from, is that whether or not we're going to see growth or a healthy growth by the end of this year. I don't think that we will. The way that I see it is that out of the 6 million or so square feet that has come onto the market of sublease space in the past year, about a third of that will expire by the end of 2022. So by the end of 2022, that space, if it's not reoccupied, and I think most of it will not be, is going to get dumped onto the direct space market. So when I look at past absorption and what would have to be true, and it just based on past absorption to get to where we were, what would have to be true in terms of a multiple of that to occupy the increased direct space and also occupy the newly dumped sublease space, I think we're going to be seeing vacancy and a lot of opportunity for tenants well into 2021 and 2022. That said, I think that people are going to wait and see what's available for them. They're going to be more creative in how they use their space. And yes, they're going to be more flexible in terms of wanting to retain good people by allowing them to work from home in a limited capacity if they need to. So it'll be interesting to see how that pans out.
Yeah, I'd be curious about that as well. And Anton, I think you're on, but I think I see you on video. We were chatting a couple weeks ago. So Anton works for Lendlease on the new Google campus in San Jose. And Anton, I'm curious, has Google kind of shifted the strategy on building out? I think I read it's going to be as large as their kind of headquarters Mountain View office down in San Jose. Curious how, whatever you can speak on, obviously, on how Google's thinking about this.
Yeah. So I'll maybe to your point, I'll say I'm speaking on behalf of Lendlease and not Google. But yeah, we were partnered with Google on 4 different master plans that Google is pursuing in Mountain View, Sunnyvale, and San Jose. And basically we are continuing work on those. So that's the kind of big piece right now is the entitlements are still moving forward, but we're 100% still in the entitlements phase on all of those projects. I think in terms of Google and kind of what we're hearing from them, Google has said pretty publicly that they value in-person collaboration and they see a future of the office very similar to what others have said on this call. I think they were already thinking of the transition from the kind of Silicon Valley suburban to a more mixed use type of environment. So I think this kind of tracks along with that. They're thinking about a more hybrid kind of approach to the office, where offices would be geared a little bit more towards collaboration than, typical 9 to 5, everyone going in every day. So I think very similar to what everyone's been saying on this call so far. And maybe the one other thing of, obviously still very focused on the Bay Area and having a headquarters here, but also expanding in other markets as they were already doing.
Awesome. And Pierce, I'd love your take. We chatted right before this call. You work for Airbnb on the real estate team. Again, I know you can't speak kind of on their behalf, but curious about your thoughts.
Absolutely. So Airbnb has stated publicly our intention to not force anyone to return to the office until after August. The company is being very thoughtful and intentional in terms of how we define the future of work. One thing that we know with a high degree of certainty is that it will never go back to what it was. The way that we work has fundamentally changed. That leaves a lot of uncertainty. We're also put in a position where we are subleasing space. We're competing with landlords in some markets, and that's an unusual dynamic, particularly in San Francisco, where, it's as a resident in San Francisco, it's concerning the speed at which the space has been added, and it's almost as though there's a race to the bottom in terms of what's happening with rates. And so as a tenant, we look to benefit from this. As a sublessor, we are finding ourselves needing to compete in ways we hadn't. In terms of what the company is planning, I can't really share in terms of long-term plans. I do think from a personal standpoint, offices will serve more as collaboration points. So one of the things that I've learned working at Airbnb for about 5 years is that culture is paramount. Culture is a set of shared expectations, and it's very difficult to set expectations when you're not in the same space physically. And so that in-person collaboration, those informal conversations that happen after 5:30, there's tremendous value that comes from those, and we need to see those again at some point. It's also, one other observation has been the fact that companies, and this is not specific to Airbnb, companies are in a very unique position where they really hadn't been before, which is an opportunity to be very intentional about the geographic growth. So before, many companies were competing for talent in specific markets, and now that the markets the people are less tied to specific markets, companies can help lead the conversation in terms of, well, maybe it makes more sense to be located in A versus B. I'm not going to dig too much further deeper into that, but it's an exciting future. It's also disconcerting. As someone who's worked in commercial real estate for over a decade, to then question whether or not we're going to need office. Certainly the answer is yes. It's going to look very different.
Awesome. So I think we'll dive into kind of Q&A portion here in the last 15 or so minutes left. So I wanted to, for those of you who dialed in late, we launched the panel with a quick poll on some interesting stats that Robert from Cushman and Wakefield shared with us. And so, before we launch into the Q&A, there's been a lot of questions about sublease and co-living. So a lot of the stats are related to this, but the poll was to pick which one is false. So the first one is, in North America, sublease vacancy increased by 80% in 2020. That is true, which is pretty impressive. And about over 50% of San Francisco's vacancy is actually driven by the sublease space, which is a pretty amazing stat. The second one is, in the last quarter of 2020, New York added the most sublease space by square footage, followed by San Francisco. And that is actually false. It's New York was number one, and then it was followed by Chicago. And then the last one is actually true. It's about co-working. So in the Americas, out of total inventory available, Lima actually had the largest percentage leased to co-working tenants, then followed by San Francisco. So anyhow, some fun facts there. And just to kick off the question, I think a lot of folks have pinged me and asked me questions about the sublease space and what's going on, and we briefly chatted about it. But I'm curious to hear kind of more from the tenant's perspective. So I wanted to see if Jen and Yulia from Rise are on as well. I think I see you on, Yulia. If you can kind of unmute yourself. We chatted briefly before about this, but curious, what are you seeing from your tenants on the future of office post-pandemic? She's still on mute. Let me see. What about Andrew? Why don't we hand it over to you, actually? I'm not sure where Yulia is at the moment, but Andrew Nichols, if you're still on. Can you kind of quickly introduce yourself and what you're seeing from your tenants?
Sure. So Andrew Nichols with CBRE. I'm based in San Francisco. My work is primarily tenant representation. And like Craig, a lot of my clients are global in nature. Going back to Robert's slide on the reoccupation of space, I actually think that number will be higher when you drill down into the information. I think with San Francisco, we have a number of tenants that I think regardless of if the pandemic had happened, they were already going to leave the city. Stripe, Uber, to name a few. And then drilling down the information you look at these tenants who have gone public and are doing phenomenally well, DoorDash, Airbnb, and they're continuing to shed space. So I think we're seeing our clients that they're forever going to change their footprint. And I do think the vacancy rates can continue to rise, offering more opportunity for our clients.
Great. And Craig, back on the kind of co-working topic, again, a lot of questions on co-working. What are some trends you're seeing in that space? On the one hand, you hear news of WeWork and Knotel, filing for bankruptcy. WeWork shutting down a couple of their major offices, and then on the other hand, CBRE took a 35% stake in Industrious, another co-working concept. So there's kind of tale of two kind of stories again. So what are you seeing in the co-working space?
Yeah, co-working is really interesting. Our clients rely on it quite a bit, in fact, for multiple reasons. It used to be that people only relied on it when there were a handful of people that needed to be in a market and it didn't justify getting a direct office. That's not true anymore. Now it's a tool that's being used for larger groups of people, still for a variety of reasons. Sometimes they're testing out a marketplace or they're not exactly sure where they're going to land from a headcount standpoint. Sometimes it's just that they want to avoid CapEx and they would rather have someone else build out the office for them. I think that co-working is an essential business model. I think it's something that's here to stay and it's going to evolve. And frankly, I am really intrigued to see that landlords, investors, people like CBRE are getting into that space. Because what's interesting about it is if you just look at co-working as a model, and we think of the 2 or 3 or 5 big names, right, that come to mind. There are really thousands of providers all over the world. Some of them are local and regional, fewer of them, but still many of them are global. And they have grown as a business so quickly in the past 2 years that I think in some instances, what we're seeing is that they were over leveraged, banking on growth, not able to really maintain their infrastructure, which is why you're seeing some shakiness in that market, which is inviting investment and also creating unfortunate situations where some of them are defaulting on leases. But I think that it'll be interesting to see how the latest trend of landlords getting into this business will reshape how those are managed. And I think that the landlord model, the landlord-owned flex space model is going to give the independent companies a real run for their money in terms of who can manage the model better. Because I will tell you that from an end user perspective, I would say that it's a great solution that needs a lot of help operationally. I think that it's often frustrating, especially for global clients, to deal with some of these flex office providers because they don't really understand a corporate client. And that has to do sometimes with how those groups are staffed, the lack of experience of some of the people handling major relationships from the inside. So it's real hit or miss, right? And I've had some great experiences, and then I've had some really disappointing experiences, but I'm really intrigued by the ownership entry into that model. I think it's going to be really interesting.
Yeah, Bill Hansen, I see you on. I know you used to work for the real estate team at WeWork, and obviously probably can't comment directly, but curious, what are your thoughts on kind of WeWork? And there's a lot of buzz about co-working post-pandemic. So kind of what are you seeing in the market? And if you can quickly introduce yourself and answer that question, that'll be awesome.
Yeah, hey, Bill Hansen, based out here in San Francisco. I'm the global head of real estate for Flexport now. But prior to Flexport, yes, I did. I led the Western US and Canada real estate team for WeWork. I agree with all what Craig said. I think that, I think one of the biggest complaints I had certainly with some of the sales team, I think you have a lot of, WeWork scaled, right? And I think a lot of people we interact with come from like a SaaS background. And when you're trying to talk about real estate with them, there's a, so I will say that from like, I agree with all those points because like certainly when I deal with HANA, it's like real estate people who get it every time. And you're just like, oh, this is great. I don't have to catch you up on, or I'm not buying software, I'm getting into real estate here. It's very simple. So I think those things, but I think there's definitely a place for it. I think, WeWork's model is pivoting. I don't think we'll see landlords get into traditional co-working. I've, in my travels, bailed them out of enough of those attempts because that's a legit business. So it requires a lot of resources. That's, but spec space, that's not a new idea. And if you're a landlord and you can, cut your floors in half and, make it plug and play and move in ready at a good rate, I think that's the niche, right? I really liked when WeWork moved into their headquarters brand. I certainly, the no-tell concept, much easier to manage. Landlords, I think, can replicate that really easy. The barrier to entry is much more difficult. So I think they'll look to diversify their portfolios, but yeah, a lot of things you said are true, right? It was just SoftBank's like, here's a blank check, take over the world. And they didn't scale correctly, right? It was just like, just get as much space, just get it. And so I think that, is a cautionary tale. So they were able to dial that back and they'll right size their portfolios. The same way, Regis went bankrupt during I think the 2009, they figured out how to restructure, a lot of these companies will do the same thing. I don't think it's going anywhere.
Getting a couple questions. We've covered a lot about kind of San Francisco and tech tenants and what they're up to. Kind of shifting coast over here, kind of back to the East Coast. Folks are wondering, what are you seeing kind of in New York and other East Coast markets? And Tom, I thought that'd be a good, Tom Lucid, I see you on there. I thought that'd be a good question for you. Can you explain kind of where you work and what you're seeing in your current office portfolio?
Sure. I work for Silverstein Properties, the owner developer, most known for the redevelopment of the World Trade Center in Lower Manhattan. But we have a large portfolio of commercial space, primarily concentrated downtown, but also in Midtown as well. And I think it's no surprise to anyone that we've seen, we've taken a hit like everyone else has, but collections have been very high. I mean, that's one of the benefits of going through an underwriting and credit process with your tenants. Physical occupancy in New York still remains low. We have been in the office since September, with parameters around how we occupy the office. And I think a lot of real estate and real estate related companies in New York have made a push to do that since, shortly after Labor Day for the most part. We've been able to do it successfully. I think Silverstein, in terms of how we view the New York market, we take like Larry Silverstein, our chairman, always takes a very long-term view. And I think there's continues to be a bullish outlook for New York. I think the comments that I made previously about the need for office and perhaps the use of office changes and becomes more of a collaborating point, as someone referenced earlier, I think is very true. And I think it's just accelerating a lot of trends that we had already seen pre-COVID, which is, building on the development side, building the most flexible space possible. And, in terms of what we have in our pipeline, the largest single office, we don't really have any office development underway except for 2 World Trade Center, which is the last major office complex outside of 5 World Trade Center, which was just recently announced. That's primarily residential. That's a large, nearly 3 million square foot office building, and that will, take some time to find the right tenant, to get the financing, to get that lined up. But the story in New York anyway with those new towers is these are typically marquee tenants who are looking for the best office space. And so at this point, it's Hudson Yards. With the Midtown East rezoning, there will be more options in Midtown as well, and it's World Trade Center. So, it's kind of a game of just shuffling around some of those major tenants to the brand new glass office building, and then it's backfilling the older product. And those are, more likely to suffer than the Class A office space.
Interesting. And then kind of back to Kim and Michael on the panelist front. But again, similar to Glenn's question that he just asked, a couple of questions on, again, shifting your office investment strategy. Again, it sounds like from the panel, office isn't dead, right? While companies like Salesforce and Dropbox and other tech companies are going more remote friendly, companies like Google and other large tech companies are still kind of maintaining that workers still have to come into the office. And it sounds like, the truth is probably somewhere in the middle. But Kim, are you guys looking at more kind of suburban office? Is suburban office back? Because the nice thing about remote culture is that it's got its pros and cons. But will that kind of shift toward the suburban markets, you think?
So I have not bought in at all to the sort of hub and spoke concept, right? So, I'm in New York City. I have folks who live in New Jersey, folks who live in Connecticut on the team, folks who live on Long Island on the team. And to have a bunch of suburban offices that are close to where they work, where they live, so they can come in but still not be part of the team, makes no sense to me. It's like just work from home or come into the office where we're all together. So I'm not buying into, let's start buying huge suburban campuses because you're going to split your team up into 2 people in New Jersey and 4 people in Connecticut and 1 in Long Island. It just doesn't make any sense. The whole point is you want to be together and collaborating and having lunch and building those relationships. We're living on the fumes of the relationships that we've had. Anyone who's new in a company, I have so much sympathy for them. It's hard to really figure out who can help you and how do you navigate things and where do you go from here as you're sitting here looking at the Brady Bunch screen every day. So I'm not a buyer in suburban office.
Yeah, Kim, I think there are a lot of tenants who totally agree with that. I've been talking to a lot of tech tenants where they'll allow kind of work from home, maybe, a couple of days a week. But when you do come in, they actually want the entire office to come in, and none of this kind of there's odd workers and even workers, and you come in on odd and even days. A lot of tenants find that it's not effective. You ruin the kind of whole purpose of synergies at work. Yeah, Michael, what are your thoughts? Is the hub and spoke model totally bogus, or will suburban office have some sort of comeback here?
So I completely agree with everything that Kim just said. I think in terms of sort of more urban focused office, I think I do have concerns, particularly for the next 5 plus or minus 5 years about the pure play financial district locations. I think that as the urban cities come back, we're going to see more traction in the markets that are more of kind of live, work, play, that have proximity to real retail, real housing, but also have transit and office there as well. And I think that those are going to be the first urban markets that are going to lease up. Menlo, by its nature, we do a lot of investing in what are deemed to be more quote unquote suburban markets, but I'm not saying that I would go buy a huge campus in northern New Jersey. Silicon Valley, Northwest and Southwest Austin, the Research Triangle in Raleigh-Durham, parts of Orange County. And it's places where there's businesses, where it's defense, it's utilities, it's engineering, it's R&D. It's where people need to be in the office and need to be collaborating. And I think just in terms of, sort of where we're bullish and where we're buying, we were very active last year, buying in the net lease space. Again, it was going after buildings that, were leased on a medium to long-term basis to those types of tenants. We did just buy last week a site in San Carlos to do a large life science development there that we plan to go spec on next year. We're a little bit iffy on, a lot of these, life science conversion plays that we're seeing in the market right now. It seems to be that that's the way that everyone's trying to get out of vacant office. But we are pretty bullish on what's going on here in the Bay Area, what's happening in San Diego, what's happening in Austin, in Boston as well in that space. And then even, starting to dip our toes, a little bit in vacant office, but in, only the very best markets. So we're going to close in 2 weeks on, a vacant office building in Santa Monica that's at 21st and Wilshire that's going to involve doing a reskinning there. So we won't really be in the lease up exercise for another year and a half. But yes, those types of locations that are really A plus locations, we're starting to dip our toe and take risk again there.
Awesome. I mean, so just to wrap up, I have one last question for the panelists, but really it sounds like, the pandemic was sort of an accelerant to embracing kind of long-term trends of having more, remote work flexibility. But it sounds like office is not dead, right? People want and need that kind of ability to come into a physical space a couple of days a week. Right. It sounds similar. A few years ago, people thought office was dead when companies like CBRE and Best Buy, I think, were, doing 100% remote. And it turned out it wasn't actually 100% remote. It's actually just more you can, work from home a couple of days a week. And to wrap up, there's a lot of young people, in the audience, and maybe Kim, we can kick it off with you. But what's kind of the best advice you can give to younger folks? It could be about, being LGBTQ. It could be about surviving recessions. Kind of any advice that you can impart on us would be much appreciated.
Are you saying I'm old and I've been through a lot of recessions, so I have lots of sage advice?
Not at all. Not at
all. So just from a career perspective, and I say this to women a lot, even when we were in the conference room, so physically there, but especially now, be visible. So you're on a Zoom with a lot of different people and you think, oh, I'm not going to say anything, or I'm just going to sit there and be quiet. This is the time where you have to really make an effort to be visible and to get your points across and to let people know that you're not just doing the task. I think someone was talking about just doing tasks. You're not just there doing the task. People don't know you're there if you're just doing the task. So really, really be visible. So that would be my sort of quick career advice.
Awesome. What about Robert?
Well, I mean, it's interesting at Cushman and Wakefield, where I've spent the last 6.5 years. We've certainly over the past couple of years made a big diversity and inclusion push. And that's great to see, but it's still the bastion of straight white men. And that needs to change for sure. It's been a difficult process, but we're certainly doing our best, and I've been at the forefront of that on the LGBTQ side. But yes, actually, go into the business, and I'll stop and say you don't go into research to make money. Most of you are more money makers than I am. But research is a great place to start. With a large commercial real estate firm, no matter which one it is, and to learn the business and to go into other areas where you might appreciate more. But yeah, I think we're certainly moving in the right direction among the big real estate players and the smaller ones too. And certainly we want to see much more of that, and we're promoting that.
Over to Craig.
Sure. So I'll echo a little bit of what both Robert and Kim said. I'm also on the Diversity, Inclusion, and Belonging Council at CRESA. And I would say that culture matters a great deal wherever it is that you work. And we've talked today about, different kinds of workplace strategies, and will people work from home or wherever, whatever the plan is, the company plan is, there must be an overlay of what kind of a culture are you trying to create at that company. And your contribution, if you're a younger person and you're a person who brings diversity to the table, among other things, is to contribute to the culture by being visible, as Kim said, and realizing that you will help shape the place that you work in. You'll make it an attractive place for other people to come to, and you'll make it an attractive place for people to stay and have their careers at, just by being who you are, and making sure that that you show up. So, I mean, I think one of the funny things about work from home and this whole effort is I just think it's really bad career advice to tell anybody that they should manage their career from their living room. I think that's just a really bad idea. So be present and bring your whole self to work.
And then Michael, last but not least, we'll end it with you.
I think there's been, a lot of wonderful things said by Kim, Robert, and Craig. I don't have a ton more to add other than just say I think it's, believe in yourself, contribute, try your hardest, and by succeeding, you're helping yourself and you're helping out, your broader camaraderie as well.
Awesome. So I think that's a wrap for our office panel. We'll have a multifamily panel hosted by Jake here. I think March 18th at 4 p.m. Pacific, 7 p.m. Eastern. So we'll send out a calendar invite and kind of save the date as well. But thanks everyone, and especially the panelists, as well as all the audience interaction. Hopefully, we'll be back in the office, hopefully this year, we'll see. Thank you, everyone. Have a good one.
Thanks for you.
Bye, everyone.